Hey everybody, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'm going to interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in there. Let's take a look, see what's going on. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com. This is where I translate all of the things that are going on in this world to actionable investments that are out there. I go over those investments. I show you the technicals. I can show you ratios that the sector is cheap. And then we can even dive into some of the fundamentals of the companies, if you like, of production growth, looking at their balance sheets. A lot of this, again, is looking forward out 12, 16, 18 months to see where the company is going, not necessarily the balance sheets of this second, even though a lot of the balance sheets do look pretty good compared to 2020. If that sounds interesting to you, if you want to learn how to invest, definitely sign up. We've got a May Day coupon code, MAYDAY. You type that in the coupon code section. You can get 50% off the first month to try it out, and you can always switch to a yearly membership for further savings. So the first one here, we've got David Tepper, Daily Compounding. He says, one of the best calls in the stock market history. David Tepper saying buy everything on CNBC in 2010. Yesterday, he said on CNBC, buy everything in China now. Are you listening? As a reminder, Baba is the largest stock holding, and he owns PDD, Baidu, KWeb, and JD. Why is he saying this? Why? So everything that these guys say, you shouldn't just walk away and say, oh, well, this guy says you should buy everything. Why? Why does he say buy everything? I'm going to tell you the why behind it. The why behind it is that the real estate market in China just went through a deleveraging phase. That deleveraging phase is when everything pulls back. And I'll pull up one of these stocks. If you want me to pull it up, I can pull one of these things up. During this deleveraging phase, everything falls. Everything. And the first thing to rebound after they do stimulus, which they just did stimulus, this is the recovery phase of a real estate cycle. The recovery phase of a real estate cycle is where you have low interest rates, low inflation. So when you have low interest rates and low inflation and they're doing stimulus, the money is going to find its way into technology companies. Tech. He is completely right, and he's looking at the bottom of the market. Now, I can tell you that this is the bottom of the market with these companies based off the charts, too. Based off the chart. So if I were to pull up a chart, and I'll just do Baba for you guys, a free opinion here. So here's my take on Baba. Baba came on down. There's your big selling pressure move since 2020 all the way down, and it bottomed October, November of 2022. We have a nice little bottom, a move higher, and then a squeeze into the dead period, which is right here. That's the dead period. Buy the crap out of it. Boom, and here we go, heading higher. This is what a bottom looks like. And I'm giving this away to everyone. If you want to sign up to the website and get individual stock picks where you basically get this buy point here, that's how we do it. And that's doing it in the commodity sector. Now, the commodity sector is going to be a lot more volatile than Baba. Baba, from bottom to top, it went from $58 to $300. I'm looking for stuff that's going to look more like this. And then you come on down, and then we are going to rip to levels that are way greater than this. Because Baba is a high, stock. It's a bigger market cap, and you may not get the leverage that some of these commodity companies are going through. So what's going to happen is China's going to go through this recovery phase. It's going to take some time, and then these stocks will bottom out, and you're going to get great buy points in the stuff that he's saying here. You're going to see the dollar fall too. So it's not just that they went through a deleveraging phase. You're going to get currency exchange rates that are favorable for a lot of these emerging markets. This is it. He's completely right here. And I'm not saying that China's the best play. I'm saying that emerging markets and all of these ideas are going to work all at the same time. We are going through a commodity bull market. And this is when China goes up. It goes up during the emerging market phase. So we're at the bottom of their deleveraging phase at the same time that our dollar is going to weaken and that we are in a little bit of a slowdown, which is going to push the dollar lower and push everything upward. That is emerging markets and also commodity precious metal stuff. We are right at that precipice, guys, where things are going to bottom and start to turn. And it may take some time. Turning doesn't mean it happens immediately. It means that the bottom has hit. We're going to come off that bottom and start to work our way on up. Investment wisdom, the first rule of compounding, never interrupt it unnecessarily. So a lot of people say, well, should I take profits? Should I do this? Should I do that? That's trading, guys. And if you're in a very good location to purchase, and you've purchased it in a very good location, and you're riding this thing up, you get 100% gain, 200% gain. The question then becomes, do I sell? Should I sell my position? Should I take some money off the table? Should I cut it in half? Should I put it in a free ride where I sell my original position and let the profits roll? According to Charlie Munger, he says the first rule of compounding, never interrupt it unnecessarily. Don't touch it. Let it ride. Now, some people might say, I bought it at the bottom and it went up 200% and then came back 50, 60, 70, 80%. That's what happens at the beginning of bull markets. You get these big, a first wave and then a big second wave pullback. It usually retraces about 60, 70%. That 60, 70% is a Fibonacci retracement of 61% or 70%-ish retracements, depending on the size of the company. Sometimes it's a 50% retracement. The bigger companies don't retrace as much, but the smaller ones that are really volatile will retrace more. And it usually scares a lot of the retail sector out of it. When the bottom of the second wave hits, you get these big, huge moves higher. So it's not about when you put the position on, and as long as you get a really good buy point, that is the most important thing. Get in when it's cheap, get a good buy point. Now, timing these things are incredibly difficult. So you want to maybe cost average in if you're trying to catch a potential bottom. And if you're 60% off its high, that's usually a good time to be cost averaging in, 50, 60% below its high. And then you cost average in a bunch and then ride it on up. The market conditions, like David Tepper is telling you, are starting to turn in favor of this bull market that's coming. So Charlie's saying, you know what, time out, get in it, get it cheap, ride it the whole bull market. Don't interrupt the compounding unnecessarily. Here's Kurt. He says, as I've been saying for months, this market has an 85% correlation to 2007. This is particularly concerning, given that the Fed started cutting rates with a 50% basis point reduction on September 18th, 2007, the same date as last week, 2024, 50 bips cut. Stock rallied then, peaking on October 9th, probably 2007. When the Fed's meeting minutes were released. This year's minutes also came out October 9th, which serves as a potential market catalyst as we head toward the end of the year. It's certainly a date to watch closely. The one thing I will say is the market is the same as 2007. 2007, we had a peak in Homebuilders. In 2006, that was the head. We started heading lower in 2007, top in Homebuilders. We had inventory growing rapidly, foreclosures growing rapidly. All of that was deteriorating hugely since 2005 and 2006. So we had a couple of years of deterioration. 2007 is not analogous to what we're going through today, in my opinion. The majority of banking and credit creation is coming from the real estate market, residential real estate market specifically. Over 70% of bank lending comes from that. Could there be something that we get a smaller pullback or something like that from another area? We could. But it's not coming from residential real estate like 2007. It's completely different. You could compare 2007, 2008 to what China just went through to give you an equal comparison. That was a real estate deleveraging event. Real estate deleveraging events don't happen often in the markets. We had it in the 1920s and then in 2006, 7, 8. China just went through it recently in their real estate market. And I don't think it's fair to compare it to that time frame. You could compare it to 2001, which was not a real estate bubble, but a tech crash, and that very well could occur. is like a 2000 recession, 2001 recession. That would be the closest indicators, sectors that look very similar. The real estate sector looks nothing like this. So you can't, in my opinion, you have to look at the leading factors for the recession. The leading factors for this recession was a real estate crash. And we don't have a real estate crash ahead of us. We have home builders going up higher. They're crashing upwards by 20, 30, 40, 50% off a breakout, which, and then these guys are comparing it to that. And it's like, it's not even close to the same comparison. Like it's not even the same. Here, I'll pull it up and use Lennar Corp as an example to show you guys. So here's Lennar, sorry, and the 2000 peak or 2007 peak is this peak right here with the shoulder head shoulder there. It's a shoulder, a head, and a shoulder. The peak of the head was 2005. We broke this on the right-hand side in 2007. The crash occurred in 2008. We had momentum coming down in a crashing home builder market. The real estate market was the driver of this. Then we had an inverted shoulder head shoulder bottom. We started coming on up. And this is home builders right now. They're heading higher. There's a lot of runway to go higher. And people don't believe me. It's climbing the wall of worry. And they don't believe me because they think the housing market is somehow stressed. Guys, during this time frame, they handed out loans to everyone. During this time frame, no one can buy homes because nobody can afford to buy them, and they're really strict on lending. We're at the beginning of this big bull market. Foreclosures are low, and inventory is still low, but it is climbing. So I'm looking to see if interest rates falling will increase the affordability and the housing starts to come back. Home builders are already front running it to some degree. If home builders were falling and they were breaking down like they did in 2006 and 7 like this, I would say you are right. We are coming for a crash. There is a crash 100% coming from the real estate market. This isn't coming from the real estate market, whatever's coming next. It's not from here. So I think it's unfair to use 2007 as an example. Another one from Kurt says the lack of confirmation for new record highs for the S&P 500 is still a major divergence that should not be ignored. Historically, this has preceded corrective volatility in markets seen in 2007, 2018, 2020, and 2022. And that very well could be the case. We could get a correction. It's just not coming from the real estate market, which is a big deal because the real estate market and commodity cycles move together. This is something different. If we get a sideways action, it would look more like 2000. And this isn't on the chart here. Because that's the beginning of the bull market of commodities. And that's where all these guys are messed up. These are not the same. Even though these are pullbacks, we're going to get a pullback, but commodities are going to go up. It's an inflationary cycle in the real estate cycle of an expansionary phase. No NBER recession, Torsten. So NBER recession indicators show that the U.S. economy is not in a recession. How is that the case? Go back. Show. Construction, employment, all of that stuff is a leading indicator of when a recession can come. And then if that is strong, which it is, NBER says no recession. It's all linked up to that. Now, could there be a recession outside of the real estate market? There could still be. That's a tough call. I wouldn't have caught the 2000 pullback necessarily, but I wouldn't have been in technology. I would have been mainly in oil, gas, materials, copper, like all that stuff. Because it's cheap. Colin Robertson says, Fitch says mortgage rates unlikely to fall below 5% before the year 2027. Expects 10-year yield to hover around current levels and end 2026 at 3.5%. A 3.5% yield plus the historical average spread of 1.8 pp would result in a 5.3% mortgage rate. So maybe that's where we level off at, is 5.3% mortgage rate. And maybe that's good enough for the market to continue higher. I don't know. And maybe they have to go slightly below that. It's tough to say. But that's where the markets, I think, are pricing where there's sustainability is a 5.3% mortgage rate. Mike Samuelson, and he talks about some of this. I'm just going to go over the charts. So this is the median price of new contracts. Single-family home prices are losing gains over 2023. And this is the current price is $389,900. It is still above 2022, and 2023. And that's where we're currently at. When we look at weekly new contracts pending, this is where we're at for new home sales pending, 62,000. We are between 22 and 23 in terms of sales on new homes or new sales pending. Weekly available inventory has climbed. We can see it climbing up to 2024, and it's in between the 18, 17, 19, and the really, really low levels of 2020, 2021, and 2022. So we are normalizing a little bit on our inventory levels, but we're still below these other areas of 18, 17, and 19, where home prices continue to go higher. So we're not at huge inventory level gains yet, where home prices go down. We're just normalizing to a below normal level. And then we've got weekly new listings, and weekly new listings are pretty much on par with previous market years. Last year, we were at a really low level, and it's up a little bit more than the low level. So we're up a little bit more, and this is where some of the inventory is coming from, is the new listings. I mean, that should be obvious. Coming down to Costco's gold bars are flying off the shelves. Costco CFO Gary Millerchip says gold sales were up double digits in the quarter. Costco sells the 24-karat gold bars exclusively to Costco members and only through its website. The bars, which Costco sold for about $2,000 last fall, were priced at $2,700 on retailers' website Friday, although they were listed as out of stock. So they're getting a lot of demand, physical demand, for gold through Costco, which is pretty cool. Hoyfin says, Druckenmiller on why you should never invest in the present. So he says, it doesn't matter what a company's earning, what they have earned. You have to visualize the situation 18 months from now. That's where the price will be. So you have to look forward out 12 months, 16 months, 18 months to see where the price will be out there and how the impact, the business impact will be from that point and what their earnings per share will be. There are a few companies that are really low right now that I think will do incredibly well 18 months from now. Incredibly well. And in fact, I just talked about one of my favorite companies on the website question and answer session. And right now it's down, and it's probably my most conviction company. And I'm looking out about 18 months saying, I don't know how these guys are not going to make a buttload of money. I just don't know how. And they are at a very attractive price. And there's a lot in the pipeline that I'm not going to say is 100% guaranteed, but it's got a good high probability of outcome of happening. And they're in the process, they're right in the beginning of that process of bringing those things online. Jeff says, firstly, we don't know when the leading lagging ratio will stop falling. It could keep declining for a while for all I know. But once it does find its cycle low, since the 1950s, we have seen the number of scarily unemployed people who have been out continues up for another 5 to 22 months after that, excluding COVID. This paints a picture of labor woes being thematic, but possibly 2026 too. And he's talking about where this could potentially go and how it could impact maybe the future and the unemployment rate is what he's seeing there. Here's the blue door. You go back in time and fix all your mistakes, or the red door, $10 million in cash. What would I choose? Now, I don't care about going back in time to fix my mistakes. I just want to go back in time. So I would choose the blue door, and I don't need $10 million in cash. I can make the $10 million. I want to go back and be young again. That would be sweet. And what most people with money will tell you is that you could take their money. They just want to be young again. So the value is time. It's not money, in my opinion. It's time. So I would choose the blue door. I would go back to, I don't know. I'd probably go one day after I graduated college because I don't want to go back through college. I do not want to go back through that. So I would do that. I'd be 20, 22. I think I graduated when I was 22. So I'd be 22 again. There you go. The Mongrel Cat says Sweden, with 6 existing nuclear reactors generating 30% of their power, is not waiting around to build more. News is out that construction will begin on the next reactor before next elections in 2026 in their efforts to massively ramp up nuclear power. So go Sweden. You're actually doing something smart. You're doing something smart. JC Parrott says China has been the talk of the town after having its best week in history. But notice how emerging markets ex-China are already hitting new multi-year highs and have been leading the way even before China got going. So this looks good to break out here to a new 52-week high for emerging markets ex-China. So that's your emerging markets. That's the weakening of the dollar and then the strengthening of those other currencies. The key to getting Chinese economy moving in the right direction is consumer spending. And boy, do they have a massive engine of savings sitting there ready to be spent and invested. Chinese households have close to US 21 trillion stashed away in bank deposits in mid 2024, while households have circa 900 billion in the United States. They have 21 trillion. That is insane. Consumer spending in China is less than 40% of GDP, while in developed economies like the US, it's closer to 70%. The Chinese have some of the highest savings rates in the world. US is at 4%, China at 44%. And there's the saving rates just ripping it to the upside for savings in China. Still on track for $48. The silver dailies point figure chart since 1802. Peak, and then we want to break that. We want to break that level there and break out and just run, Forrest, run in silver. So that's still there. Step 2 is $85. Is step 2 where he's got it there at 85. Step 1, 48. Step 2, 85. For silver, the big breakout level using the yearly time frame is $31 to $32. One of the most significant breakouts in history is in the making. That is really one very, very good looking chart. Here's your cup and your handle, and we're close to the breakout of $31, $32. We're at 30, I think we're at 32 still. I'd have to look again, but this is the mother of all very probable cup and handles. The bigger the base, the higher the space. Massive cup and handle. Coming down, so what's going to cause this big move in silver, right? This is global liquidity, upswing in liquidity. This peaked and bottomed at October, September of 2022. Let me show you something, guys. So going into copper or to gold, this was the bottom of gold here, October of 2022. That just so happens to be exactly the bottom of global liquidity index. As liquidity goes up, gold goes up. This has a long way to run higher if we get back to the peak over here. Now, will we get to 60 or 80 index? I don't know. I don't know if we go that high or not, but we're going to go up for a while. That's going to push gold up for a while. It's also going to push our boy silver to the moon. Silver, this guy right here, that's ready to break out. So do you think it's a coincidence that these upward moves track this liquidity cycle? Now, here's the thing. Liquidity coming into the system also has to match up with other cycles. So if liquidity comes into the cycle under an expansionary phase of real estate in America, and we've got stimulus coming into the system over in China, they're at a little bit different location. And we've got the K wave of commodities coming up. So this liquidity is just going to be extra fuel for all of those background cycles, the bigger, longer cycles. So this is a shorter term cycle that is in a longer term cycle of the real estate market, and then a really long term cycle of the K wave. So all of that is stacking up for this massive 45-year cup and handle, which is the K wave. The K wave is this big cycle that happened in the 70s and that started in 2000, and then the consolidation here. This is the beginning of the new K wave that is starting, and the real estate cycle that's an expansionary phase, and the global liquidity index going up, and that's that confluence of information and data that I'm looking for. So this is one of the best investments, in my opinion, to look at. Are these things that are down that are going to benefit from all of these cycles hitting at the same time? The mother of all very probable cup and handles, silver and other ones that we talk about, again, on the website. So here's some more quotes. It says, "You must have the discipline and temperament to resist your impulses. Human beings have precisely the wrong instincts when it comes to the markets," says Walter Sloss. There we go. "It's crucial to be able to resist your human nature." Peter Lynch, right there. So refinancing boom. Here we are in the NBA refinance index coming on up. Liquidity, 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 liquidity. It's all the same, guys. There it is. Here it comes. It's coming back. And this is just America. It's not the whole world. This is just refinancing index is coming back. And that's where we're going to end it, guys. So that's what I've got for today. Give me a thumb up for the content, guys. Subscribe to the channel. Subscribe to the website. Mayday coupon code is active. Again, this is going to be released on Sunday. So we'll have a midweek update out on Wednesday. And then next Sunday is going to be our question and answer session at 5 p.m. Mountain Time. But that's what I've got for today. We'll catch you next time. This is Finding Value.